In this video, I explored the benefits and drawbacks of profit maximization, as well as why profit maximization is not always the best option. Profit maximization is the process by which businesses ensure that the best output and pricing levels are attained in order to maximize their returns. The firm adjusts influential parameters such as sale price, production cost, and output levels to achieve its profit targets. Profit maximization is a positive thing in business, but it can be detrimental for the client if, for example, lower quality materials and labor are employed, or if the firm decides to increase project execution prices in the pursuit of profit maximization. Advantages of profit maximization. Profit is necessary for a company's survival. Profits are the appropriate metric for determining the viability of a business plan. In the lack of earnings, the company loses focus of its primary mission and faces a direct threat to its survival. Profits in a business reflect efficient utilization and allocation of resources. Resource allocation and payments for land, labor, and capital, as well as the organization, contribute to social and economic well-being. Disadvantages of profit maximization. Organizations and people have different interpretations. Profit, for example, can be defined as gross profit, net profit, profit before taxes, or profit rate. The formula assumes that the larger the profit, the better the proposal. But what about its timing? When examining present value in finance, we know that cash now will not have the same value in the future. In the chase of profit, risks are neglected, which may become unsustainable at times simply because increasing risks directly call a business's survival into doubt. The most difficult aspect of profit maximization as a goal is that it ignores intangible benefits such as quality, image, technological breakthroughs, and so on. However, the contribution of intangible assets to the creation of value for a firm is not to be overlooked, as they indirectly create assets for the organizations. Profit maximization has been criticized by several economists for creating wide gaps between consumers and manufacturers. Profit maximization should not be a company's main goal in cases of imperfect competition, even though it may seem appropriate and a reward for efforts in perfect competition. When there was little competition, selling and manufacturing products were essentially for mutual gain. Manufacturers produce for mutual benefit and social good rather than profit. The sole producer's goal was to maintain his market position and sustain growth, earning some profit to help him maintain his position. In contrast, today's production system is dominated by a two-tier system of ownership and management. Ownership seeks to maximize profit, whereas management seeks to control the production system, thereby indirectly raising the business's income. Customers consume these services, and as a result of the establishment of cartels and monopolies, they are obliged to pay a higher price. Not only have the customers been harmed, but so have the personnel. Employees must work for above their capabilities. They are required to work extra hours in order for output to keep growing. Many times, manufacturers build things that are of little usefulness to society and then utilize rigorous marketing and advertising to create an artificial demand for the product. They make the goods so appealing through packaging and labeling that it is impossible for the consumer to reject. This is most common with products aimed at children and teenagers. Ad commercials and print advertisements frequently give incorrect information in order to artificially raise the product's expectations. In the case of oligopoly, where the nature of the product is similar, exploit the client to the fullest because they form cartels and influence prices by providing consumers very little flexibility to bargain or choose among the things provided. In such a case, the consumer becomes the victim of these acts. Profit maximization is constantly attempting to increase the firm's revenue while focusing less on social welfare. The government plays an important part in putting a stop to this practice of charging excessive charges for a service or product. In fact, a market with a high level of competition is more likely to exploit the consumer in the name of profit maximization, whereas where production of a certain product or service is limited, the possibility of charging higher prices is larger. There are few topics that require more clarification when it comes to profit maximization. Profit maximization is a little unclear in terms of returns achieved by an organization over time. When calculating profit, the time value of money is frequently overlooked and causes return uncertainty. Two enterprises that use the same technology and production elements may eventually achieve different returns. It's because of the profit margin. From a different perspective, it may not be genuine. Thanks.